Good morning, good afternoon, good evening, everybody. Welcome to this RVW Wealth presentation. We're happy to have you with us. So I see we have a very large group watching from around the world and using almost every medium of social media, YouTube, etc. that's known, and we welcome you all. As is our policy, we try to focus on education, and we don't focus on marketing. We actually don't have a marketing department. We have an educational team, and we're very honored today to welcome Weston Wellington to be our keynote presenter. Weston is a vice president at Dimensional. Dimensional is one of the core funds that has inspired and directed RVW from its very beginning. Dimensional is the home of what's called evidence-based investing, the science of capital markets, going beyond stock picking and market timing towards data-driven, logical, rational, sane investing in a style that makes sense long term. And Weston Wellington is able to take uniquely, I think, tons of data and make it intelligible and actionable. And that probably is his greatest strength, is the ability to cut through the data and get to what it means in terms of how investors should view their portfolios and the world from an investment standpoint. We're very proud of our association with Dimensional. We're very proud to have Weston Wellington on. I think he's probably their number one presenter, and it's humbling for us to have someone with his 30 years of experience to share wisdom, insights, and what we call evergreen wealth wisdom. This is not a place you come for stock tips or short-term, panicking decisions. It's about how you keep a steady hand on the tiller, particularly in turbulent times, how you deal with headlines, and how you keep, as Warren Buffett says about the poem by Rudyard Kipling, how do you stay calm when all about you are losing their heads and blaming it on you? And so with a dose of wisdom and insight, particularly at these times, when headlines are so confusing, contradictory, unpredictable, and can lead to mistakes in terms of thinking and investing, it's a pleasure to have the wisdom, the insights of a gentleman of this stature with us. And Weston, it's my honor on behalf of all of us at RVW to thank you and to welcome you. Thank you very much.
And thank you. And it's a pleasure and an honor to be here. I spent the last 50 years in the investment industry, most recent 30 years with Dimensional. And I might say somewhat rudely from my standpoint, I took 20 years to figure out I was doing it the wrong way. In the last 30 years, doing it the right way. And the right way is really no more complicated than allowing the power of freely determined prices to guide you toward a successful investment experience. And one of the hardest things to do to take advantage of the power of markets is to try to ignore the temptation to second guess the prices that millions of other investors have already decided are the appropriate prices for securities. And so I'm going to take about a 50-year trip down memory lane and remind us of some of the alarming headlines that we might have seen over the years and ask ourselves, how difficult might it have been to stay in our seats? Now, this title here is actually a bit of a nod to one of my colleagues at Dimensional, Aaron Alley. He's a big soccer fan. Traveled all the way to Brazil back in 2014 to watch World Cup soccer, Germany versus the U.S. Long plane ride down to Brazil. Very long bus ride to the stadium. He gets there, it's pouring rain. He'd packed light, didn't have any rain gear. He scrounges a trash bag to keep dry, makes his way to the stadium, and thankfully the rain stops. The game starts. Hard-fought battle. Entire first half, no score. Well into the second half, still no score. Aaron's kind of thirsty from his long journey. He gets up and goes to the concession stand. And just for the few moments, waiting in line for his drink with his back to the field, a huge roar goes up. Germany has scored. Turns out to be the only goal of the entire game. Germany wins 1-0. Aaron thinks to himself, this is a lot like the stock market. And some of the best returns come when you least expect them. I traveled all this way to Brazil to watch the match, and I missed the key moment of the game, because I wasn't in my seat. So with that little anecdote in mind, let's survey a lengthy period with many events that might have caused some of us as investors to get out of our seats, so to speak. I was a college freshman when this gloomy assessment from Time magazine appeared, the sharpest downturn in U.S. stock prices since the Great Depression. If it's even remembered at all today, it's sometimes referred to as the forgotten bear market, because it was overshadowed by an even sharper downturn, 1973, 1974. Long lines at gasoline stations, turmoil in the White House, unraveling economy, plunging stock market. And even when the stock market began to recover in 1975, it still seemed like we were in rather shaky ground, financially speaking, at least in some of the nation's major cities. Fast forward to 1979, and we have the now famous or perhaps infamous cover story from Business Week, the death of equities, how inflation is destroying the stock market. That's a pretty harsh assessment. Why was Business Week so negative? Where was the Dow Jones Industrial Average, 30 prominent companies, when this cover story appeared? 875. Just about exactly where it was 15 years earlier. Now, granted, you got some dividends along the way, but this is presumably no one's idea of a rewarding stock market environment. Maybe you have a somewhat acrimonious chat with your financial advisor at this point and say, this whole stock thing really isn't working out. This article makes a lot of sense to me. I think we should sell everything and never look back, never buy stocks again. How have we done for the last 10 years, by the way? Well, your advisor says, we have a diversified portfolio. We don't have all of your money in stocks, but just a useful comparison. S&P 500, a useful benchmark for stocks with all dividends reinvested, $100,000 grew to 177. But 1 month treasury bills made even more money. Ha! Just what I expected, you say. No wonder I've been so disappointed. I think Business Week is right. I should never buy stocks again. Why invest in risky stocks if you make more money in treasury bills? Your advisor says, now look, I know it's been a painful, long wait here, but I really do think you'd be making a mistake. First of all, we don't have all of your money in stocks, but most importantly, stocks are riskier, and if the world works properly, riskier assets should have higher returns. I think this is going to turn around. Well, how long do I have to wait? You say, somewhat harshly. Your advisor says, look, truthfully, I can't say, but I think a year, 2 years, 3 years, I think we're going to see a more rewarding environment. You leave the office saying, I'll be watching you. 1980 opens up, next decade. Hunt Brothers looked like they were going to bankrupt almost every big brokerage firm. They were speculating on silver. They wanted no part of the US dollar. They were convinced inflation was rampant and the dollar would become worthless. But when the price of silver began to go down rather than up, they got a margin call, a big one, $100 million. Come up with more cash or we have to sell your silver, the brokerage firm said. It looked for a brief moment like they might bankrupt all the big brokerage firms. Stock prices plunged, but recovered. 1980 turned out to be a very good year for stock prices, not so good for the Hunt Brothers. They filed for bankruptcy and permanently banned from the commodities markets. Well, it's August 12th of 82. The 3 years are up. You're back in your advisor's office. Time's up. I'm out of here, and I'm never buying stocks again. No thanks for the memories. Well, if that was how the scenario unfolded, congratulations. You managed to sell out of stocks on the very last day of a long, painful downturn in U.S. stock prices. Because August 13th of 1982 was the very first day of a still unfolding bull market cycle that has sent the Dow Jones to over 40,000. Were you on the train when it pulled out of the station? Or were you left standing on the platform, reading your copy of Business Week? We have a few fair to middling years and then a devastating one-day stock market crash in October of 87. So unexpected, so tumultuous. so inexplicable that much of the commentary at that time suggested something has permanently changed in the financial landscape surrounding Wall Street. All that had really changed, in my view, we'd set a peculiar new record of sorts. We had a conventional so-called bear market, meaning a loss of more than 20%, compressed into one single trading day. Then we're back to the ordinary ups and downs of stock market activity. And in the background at that time, as I recall, there was this growing anxiety, concern that big U.S. companies had lost their way. We'd lost our edge. We were being out-engineered, out-innovated, out-marketed by more clever competitors from other countries, particularly Japan. But on the whole, the 1980s were a rewarding decade for investors in stocks in the U.S., and our $100,000 has grown to almost $900,000, and we're well ahead of our neighbor in Treasury bills. Next decade opens up. Boy, do we have things to worry about now. Another recession seems to be unfolding. Kuwait has been invaded. There's a massive military buildup on both sides. At any moment, it seems, a shooting could start. Some brave souls announced at that time, well, when the shooting does start, obviously, the stock market will collapse even further. And if you're really adventurous, that might be a good time to pick through the smoking rubble to find some bargains to buy. Do we recall what happened? The day the missile started to fly over Baghdad, January 17th, 1991. The stock market exploded on the upside and never looked back. 1991 turned out to be one of those well above average years, the kind of year you cannot afford to miss if you want to get the long run capital market rate of return being handed out just for showing up and participating. Later that year, we began to hear an argument we're still hearing echoes of more recently. The argument goes something like this. Look at stock prices today and compare them to any sensible measure of company value. Prices relative to their profits or their dividends or their asset values. They're so far above their long-run average, this can't possibly be a good time to be buying or holding stocks. You should sell them and wait until they're more appropriately valued. The following year, Time magazine tells readers it's the longest period of sustained economic weakness since the Great Depression. Who's this guy? Barton Biggs. What a great name, Barton Biggs. The very first individual to have the title Chief Investment Strategist. Why is he wearing a bear costume for this cover story? Mr. Biggs tells readers, I have a confession to make. I voted for Bill Clinton, and I made a huge mistake. Bill and Hillary are a disaster for the U.S. stock market. Get your money out right now. Well, 1993 was about an average year for stock returns in the U.S., about 10%. 94, to give Barton some credit, not so good, but not terrible. Prices were basically flat for the year. You got your dividends, not much else. 1995, we're off to the races again, another well above average year for stock returns. But in October of that year, Joe Granville appears in the pages of Barron's Financial Weekly. Mr. Granville had published a market timing newsletter for many years, and he had made some uncannily accurate predictions for stock prices, both up and down, late 70s, early 80s. He now tells readers everything he has learned about studying all the patterns and squiggles in stock prices leads him to an inescapable conclusion. We are destined for another devastating stock market crash, similar in scope to that of October 1929, and it's only a matter of a few weeks away. At the very most, a few months away. The weeks and months go by. There's no crash. Prices go higher still. The chief investment officer for a major insurance company tells us he's never been more negative on the outlook for stocks in his entire investment career. Money magazine chimes in. Now is the time to take your investment chips off the table. Maybe by some miracle you had resisted all these suggestions to fiddle with your portfolio, and you had remained with whatever you thought was a sensible allocation to stocks. So what happens the next year, 1998? First half of 98, stock prices go even higher. S&P index up another 16% or so. Then along comes August of 1998. That wasn't literally true. It just felt that way at the time, that every single day in the month of August, we had another version of the anguished trader photo appearing in the newspaper. Well, why were people so alarmed? The Russian government had defaulted on its debt. It triggered a sell-off in other bond markets around the world, spilled over into stock markets all around the world. You're reading your month-end August statement. It's early September. Not very pleasant reading. Except now what are you hearing? You're hearing this isn't some ordinary stock market correction. This is a full-fledged global meltdown. Stock markets are falling like dominoes all around the world. No one seems to have predicted it. No one seems to know what's going to happen next. And the phrase we heard over and over at that time, this is unprecedented. Who in their right mind wants to have a big dose of stocks in their portfolio in an unprecedented economic or market environment? So here we are, September 1998, wondering, worrying, how deep, how long, how painful is the crash of 98 going to be? And somehow, 8 months go by and this financial hurricane has disappeared. And now we have a new concern. It's our irritatingly attractive next-door neighbors getting filthy rich investing in technology stocks. And not just our next-door neighbors, the golf pro, the gal bagging groceries. Everybody seems to be making more money than we are in the stock market. Perhaps because we sold all our stocks 2 years ago after reading Money Magazine. But it's not too late. According to Harry Dent, at least, in this book published in 1999, he lays out a very appealing vision of the future. A golden era for investors lies just over the horizon, powered by unavoidable demographic trends, aging baby boomers and so forth. He sees the Dow Jones average skyrocketing to 40,000 by the year 2008. Hold that thought for a moment. We'll come back to it. So now our $100,000 at the close of this decade is now 4.7 million, even farther ahead of our neighbor in Treasury bills. Next decade opens up a brief flirtation with all-time record highs. And these two authors, channeling Mr. Dent, say, yes, 40,000 on the Dow is certainly in the cards. But 2008, that's a long way off. We don't think you have to wait that long. We think the Dow ought to be 36,000 right now. Based on the author's contention that relative to yields on high-quality bonds, stocks were still massively undervalued. Well, 2000 turned out to be a down year for stocks, triggered by a dramatic sell-off in many technology-related issues. 2001, another down year for stocks. Notice how the happily married couple is now the grim-faced individual. 2002, the third year in a row of negative stock market returns. This article appeared the day after stock prices hit their very lowest point for the year and the lowest point in that nearly 3-year downturn. What does the news tend to look like at the low point in a stock market downturn? It tends to look pretty grim. That's one reason prices are so low. The reporter here asked a bank trust officer, what do you think? Time to buy stocks? They've come down so much. What did the banker say? What are you, nuts? Look around you. The whole world is falling to pieces. This is no time to be buying stocks. And yet just 4 days later, we'd seen one of the strongest rallies in stock prices in something like 7 decades for no obvious reason. Stock prices rarely go straight up or straight down. They pulled back somewhat the following year, although never came back to their previous low point. Once again, this article appeared in the Wall Street Journal the day after stock prices hit their very lowest point for the year 2003. And once again, what does it appear many investors are doing with their stock market holdings? Stampeding for the exits, to lock up safe returns in treasury bills or bank CDs, and missing out on a gain of over 30% between the day this headline appeared and the end of the calendar year. Another one of those years you cannot afford to miss. And it took place despite a mysterious virus that appeared at one point it might bankrupt the entire global travel industry. Then we're back to the daily grind, worrying about the economy, worrying about oil prices that will inevitably go to the high triple digits, we were told, worrying about our friends making more money than we are in real estate, or maybe not making more money than we are in real estate, leading to a devastating financial crisis, a very stressful time for many investors. As the economic news throughout 2008 and early 2009 seemed to get grimmer and grimmer with every passing day, and stock prices kept grinding lower and lower and lower, this article appearing in late February in the Financial Times seemed to capture the mood perfectly. There's just no end in sight for this downturn in stock prices. This is a teachable moment courtesy of the Financial Times. This is technically a 100% true statement. There's never an end in sight for any downturn in stock prices or any upturn in stock prices. We just don't know for sure what's going to happen next. As we now know, this harsh assessment of the future appeared just 8 trading days before the beginning of one of the longest and strongest and most profitable bull markets in the entire history of the United States. Once again, were you on board the train when it pulled out of the station? And in the background at that time, there was also concern in some quarters that we had a new occupant of the White House with perhaps a sharply different view of the proper relation between business and government, leading at least one observer to claim in this op-ed piece appearing in the Wall Street Journal that all of the recent weakness in stock prices could be attributed to the behavior of just one individual who happens to occupy the White House. I am not suggesting that anyone abandon their political beliefs. I am suggesting be very skeptical of your ability or anyone else's ability to apply those beliefs in a manner that will enhance your investment results. Vote your convictions at the ballot box, not with your life savings. And this particular op-ed piece gets my Yellow Stinker Award for being the very worst market timing prediction in all of my voluminous files collected over the last 50 years in the investment industry. One trading day before the U.S. stock market exploded on the upside. The Dow Jones average actually hit bottom early March at 65.47. That very day, a TV news reporter had interviewed Warren Buffett, chairman of Berkshire Hathaway, renowned investor. He told the reporter the U.S. economy's fallen off a cliff. Well, who wants to argue with Warren Buffett? What the reporter failed to tease out from Mr. Buffett is that he'd been actively buying stocks for Berkshire's portfolio while the U.S. economy was falling off a cliff. And as stock prices began to rise explosively sometimes, March, April, May, and June, many investors were puzzled. How can stock prices be going up when the economic news is still so bad? And not just individual investors, the vast majority of so-called professional investors were equally bewildered. This is Alan Abelson pictured here, peach of a guy. Wrote a weekly column for Barron's for over 4 decades, the wittiest observer of all things related to markets and finance. But even someone with all of his experience and wisdom, he was caught completely flat-footed by the upsurge in stock prices in 2009, insisting in August of that year that this marvelous movie we've all been watching will run backwards, guaranteed. Now, this is a key advantage of being a financial journalist. You can use the word guaranteed as many times as you want, in front of as many people as you want, and no legal authority can lay a finger on you. So where do we stand at the close of this decade, 2009? Let's see, our terminal wealth is 4.2 million. 4.2 million? 4.2 million? Didn't you tell me I had 4.7 million 10 years ago? Yes. Didn't I reinvest all of my dividends in more shares like you told me to? Yes. Well, what happened? I'm missing at least $500,000. What's the message here? Stock prices don't always go up. There can be uncomfortably long periods when they don't. If that happens, can you stick with the program? Next decade opens up. Many observers telling us at that time, the moment this so-called artificial government stimulus program comes to a close, It will knock the props out from under the economy and the stock market. Just a brief shout out to The Economist. They have consistently the most alarming cover story images. So apparently we're about to get torn to shreds by financial sharks in the water back in 2010. And there were certainly plenty of reasons to be nervous. Despite a so-called economic recovery, banks are still failing left and right across the country. The U.S. has lost its top AAA government credit rating. We survived the sharks in the water. We're about to get electrocuted back on dry land. Martin Wolf, deemed to be the most astute observer of all things financial, telling Financial Times readers that the U.S. economy is sinking into the great stagnation. Now, most journalists, in my history of dealing with them, if you talk to them after hours in the bar, they'll agree, yeah, trying to time the stock market, when to be in, when to be out. It's an exercise in frustration. Don't do it. But sometimes they just can't help themselves. To Brett Aarons, more than a decade ago, it was so obvious that stock prices were so overvalued. The only sensible approach was to follow some sort of timing strategy. The Economist telling us that whatever the cycles of economic expansion and recession may be in this country, the very long run growth rate in the American economy is now sharply and permanently lower. There's a huge sell-off in stock prices in 2014, another one in 2015, another one in 2016. Later that year, we have a controversial new leader in the White House. We have controversial leaders in other countries. We have many so-called experts telling us the party is over. Fortune magazine chiming in with a more religious interpretation, but a similar message: get your money out. The New York Times has an alarming airline analogy at year-end. Attention, investors. Buckle up and assume the crash position. Are you ready for next year's financial crisis? Business Week piles on. One week where New York Times was correct. Business Week piles on. Hope all you investors out there enjoyed the Trump bump in stock prices. Now, brace yourself for the Trump slump in the economy and the stock market. Now, imagine it's the first week of 2019. All these voices of wisdom and experience seem to be saying the same thing. Now is the danger time. Now you're overconfident. Now you think you're going to get double-digit returns off into the future. It's not going to happen. Not for this year ahead. You'll be lucky to get single-digit positive returns. You better brace yourself for a loss. How many investors remember what the rate of return was on U.S. stocks in 2019? Was it about average, 10%, like almost no one was predicting? No. 15%? No. 20%? No. 25%? No. Just a shade over 30%. Not only have I been unable to find anyone with any stature in the investment industry who predicted that outcome, I can't find anyone who can explain why it happened after it happened. Another one of those years you cannot afford to miss. So where do we stand at the close of this decade, 2019? Well, now our terminal wealth is finally well ahead of our neighbor and treasury bills, over 15 million. Next decade opens up, yay, all-time record highs. And then what happens? News of this mysterious virus filters in. Markets begin to go down and down and down. James McIntosh of the Wall Street Journal helpfully telling readers in mid-March, however bad it's been so far this year in the stock market, could get much worse. And he was absolutely right, at least for 1 week. Stock prices fell the following week at an even faster pace than they had during the October crash in 1929. But just as suddenly, a powerful rally seems to come out of nowhere. So unexpected that not just individual investors, but the vast majority of professionals were convinced, don't fall for this. This is a classic bear market rally. This is April of 1930 all over again, after the crash of 1929. Don't fall for it. The worst, by far, is yet to come. And it's not hard to understand that viewpoint. The economic news wasn't just gloomy. It was seemingly getting worse hour by hour, day by day. The New York Times needs creative graphics to capture the collapse in retail sales. However bad it's been, it seems to be getting worse. Who could have imagined, with unemployment in this country in 2019 at a 50-year low, that anyone could be talking sensibly about a 17% unemployment rate less than a year later? All the experts at the Federal Reserve telling us the pain will last for years. Company executives chiming in with a similar story. Time magazine telling us a global depression is unfolding. And yet somehow, just 2 weeks later, the U.S. stock market hits an all-time record high, leading at least one veteran market observer to claim at that time, this stock market is nuts. Hold that thought for a moment. We'll come back to it, but briefly pivot to a refresher. One of the more contentious election cycles in recent memory, or maybe even distant memory. Did anyone predict that Joe Biden would be elected president? Sure, lots of people did. Did anyone predict that Joe Biden would be elected president and we would have the strongest week in the U.S. stock market following an election since 1932? I'm still looking for that one individual who made that forecast. Help me out. I'll give them credit. So at the close of 2020, our $100,000 is over $18 million. 2021, another year when most so-called experts were neutral or negative on the outlook for stocks. And it was certainly a very challenging year for many students, parents of students, those of us trying to heat homes or fill gas tanks at reasonable prices, and another year of well above average stock market returns. Let's revisit this notion that, in the words of a New York Times financial journalist, the stock market in the U.S. in the summer of 2020 was divorced from reality. I can forgive individual investors for being occasionally puzzled by stock market activity. I have a harder time forgiving financial journalists who write about these topics for a living. What is a stock? Well, it's a claim ticket of sorts, a claim on the profits and dividends of any particular company. And there's no expiration date on that claim ticket. It's often to perpetuity. Investors gather around stock exchanges all over the world, and they trade these tickets amongst each other. Well, how do they decide what a fair price might be, either as a buyer or a seller? Well, they tend to study these companies very carefully, try to assess not just what's going on today, but what might happen tomorrow or next year or 3 years from now or 5 years from now or 10 years from now. And because they're competing with millions of other investors, there's a very powerful incentive to move quickly at any sign of a change in the news background, either positive or negative. So we should not be surprised when from time to time the stock market can move explosively upward when the news is still black, but just a little less black than we were expecting compared to the previous day. The stock market is always looking through the windshield ahead, not in the rearview mirror. It's trying to anticipate the headlines we will be reading in 6 months or 12 months. The stock market does a much better job of predicting the economy than the economy does predicting the stock market. So where do we stand at the close of 2021? Well, very nice, over 23 million. Roughly speaking, 1 out of 4 years in the U.S. stock market experience have been negative. 2022 was another one. Seemed to be grinding lower and lower throughout the year. Darn, another year we're back below 20 million. What seems likely to happen to the economy and the market in 2023? Parade of economic experts telling us expect a recession and expect the Federal Reserve to keep ratcheting interest rates higher and higher and higher in an effort to crush the inflation dragon. Now, suppose your fairy godmother appears to you at this moment and says, you're probably a little anxious about the outlook for the future. I'm allowed to give rewards for a very small number of people who've lived good lives and generous lives. You're one of them. So I'm going to show you some headlines you'll be seeing, everyone else will be seeing as well next year. I can't tell you what stock prices will do. I'm not allowed to, but I can show you the headlines, and you can decide if it's going to be a rewarding year for stocks or not. So you'll be reading that investors are going to be bracing for turmoil. There's going to be the second largest bank failure in the entire history of the U.S. U.S. government threatens default on its debt. Economists arguing not just if there will be a recession, but will it be an ordinary recession or a very deep and nasty recession? You'll be reading it'll be the worst comparisons for company profits in many years, the highest interest rates on mortgages in over 2 decades, oil at $100 a barrel, kindergarten antics in the House of Congress. What would your forecast have been for stock prices had you been privy to advance notice of all these headlines? Yeah, sure, all-time record highs. Why not? So I close at 2020. Our terminal wealth is a bit over 24 million. And 2024, a very similar number. And if anybody's interested, they may want to compare what stock prices have done compared to government bonds or gold over the last 40 years. Did you stay in your seat and turn $100,000 into over 30 million? Or did you jump out, so to speak, and never sit down again? So am I suggesting that everyone in the audience should have a big dose of stocks in their portfolio? Absolutely not. But I do find favor with an observation made many years ago by Princeton economist Burton Malkiel. He said, I think almost everyone should have some portion of their assets in stocks. Now, he didn't say how much. It could be only a little. It could be a lot. That's a great conversation to have with a professional financial advisor. Almost every golf player, golf pro, tennis pro, they have a coach. Not because they don't know how to play golf or tennis, but because they can be at the top of their game with someone offering independent, unbiased advice. So whatever the allocation to stocks might be in your portfolio, a little or a lot, I would strongly urge you, stay in your seat. So I'll stop there, take any questions about anything I've talked about or anything I haven't talked about. Thank you all for coming today.
Thank you very much, Weston. It's an honor to hear you, and of course, we know what you do with the headlines. We've learned from you over time, and we're proud at RVW to specialize in ignoring headlines. We try to distinguish the noise from the news, and not to get cluttered by that. We don't generally. We're not going to be opening this for questions at this point. I think it's fine. I think you answered anything that could be asked. They say it's not timing the market; it's time in the market, and we're firmly into that mode. I think your wisdom in the investing sphere is correct. There is a place for equities, and always not to confuse risk and volatility. A well-diversified portfolio, in our view, presents volatility, but over time, the markets have always recovered and then some. Your masterful presentation of history, I think, is a powerful dose of reality. I hope we will all find inspiration and caution in the advice and input you have given. I always remind everybody that nothing over here is considered to be, nor is it intended to be, investment advice. And as Weston has said, you need a coach next to you to provide caution and data and to design a tailored, bespoke portfolio responsive to your own situation. With that, I thank you all very much. Wish you a joyous summer, which is around the corner, and onward and upward. Thank you very much.
And thank you, Selwyn.
Thanks.